we go. Hello, everybody. Thank you for bearing with us. We've had a few technical difficulties, but we're back on track now. So hello, and thank you again, everyone, for joining us today. Before we dive into it, I'd like to introduce myself and our esteemed panel. I'm Blake Boyer with Mortgage Advisor Tools, and I've been dedicated to the financial industry my entire career, and I've spent most of it leading high-performing marketing teams. I was lured into mortgage in 2012, so there's that. But an exciting career change for me began earlier this year after I literally picked myself up, brushed myself off after being laid off twice in 2022. So I'm not immune to the challenges of the market, and I made the decision to do something differently. And we're doing just that at Mortgage Advisor Tools. We firmly believe the data shows that the mortgage industry is on the cusp of a borrower-centric marketing and technological revolution, and we aim to serve as the catalyst for this change. We connect lenders to the right vendors. So today I have with me Alayna Gardner, the Director of Sales and Marketing at Lodestar. They are a leading provider of closing fees that recognizes the importance for mortgage lenders to offer clear, accurate quotes to everyone, no matter where they're at in the country. Prior to working in the mortgage industry, Alayna worked for hospitality for over a decade, and she carries with her a relentless work ethic and impeccable standard of quality and customer service, and was recognized this year, 2023, as a rising star by Housing Wire. Also noteworthy, Alayna's dog, Nanny, is Lodestar's adorable marketing director. From Lender Toolkit, we have CEO and founder Brumley. And let's just say Brett never had a chance not to be in mortgage. His mother worked in the industry for over 40 years, and his earliest memories include hanging around Wells Fargo and America's First Credit Union. Lender Toolkit, though, has developed technology that optimizes and runs in tandem with Encompass to make mortgage lending more efficient. They streamline operations, reduce cycle times, and help lenders achieve more while doing less. Also with us today, having some technical difficulties as well, and we're hoping he will be able to jump on and join the panel. To provide perspective of the lender is Roy George, More Lending's president. Roy is profiled as a thought leader, possessing a unique blend of operations and compliance experience, and quite honestly, sounds like a unicorn to me. So he is an out-of-the-box thinker, an industry leader recognized for implementing technologies that digitize the mortgage space and enhance the customer experience. So I'm really, really excited to get this conversation started. Hire, fire, rinse, and repeat. I think we can all agree that sounds all too familiar. And I think that we can all agree that we'd like to stop the dysfunctional cycle of mortgage lending. But how? It's time to know your tech cost per origination, period. The chaos cycle, we know, is avoidable if you are willing to think and act differently. Today, with these incredible industry thought leaders, we're going to dive into the tech cost per origination. Our conversations are going to be focused on helping mortgage companies make more money, be more efficient, and so on. But I really want to first acknowledge that we believe homeownership is the #1 wealth building vehicle in the US, and we can make it more accessible, more affordable, and less complex. Everyone wins. So with that, I'm going to set the stage and start here a minute and take a look at some data. So let's take a look here as this loads up. Excellent. All right, so taking a look at this chart, it's data from the MBA's Economic and Mortgage Outlook presentation from the beginning of the year. And this graph really stood out to me. Technology expense as a percentage of total company costs increasing. So honing in on the large and mid-sized independents, we can see on average their tech budget accounts for only 6% in 2021. We don't know if that's a good or a bad thing. Should it be higher? Should it be lower? And it's something, to note as we dive into these conversations. Something else as well, from 2013 to 2021, the large IMBs increased by 2.2%, and the mid-size independent tech expense only increased by 0.6. So why is there such a discrepancy across all IMBs? And today, we believe this begs the need for lenders to understand their tech cost per origination. Moving on to the next area, to keep your wheels turning as before we dive in, let's look at some additional information as it relates to loan production expenses. On average, tech-related costs only counts for 6.7%, and a whopping 62% of the pie is personnel expenses. That's 8 times greater than technology expenses. Sales personnel expenses, I would like you to take a look at here, 27% of the total loan production expense. And in today's environment, we know the borrower wants to do most of the work with the technology made available to them. So I'm going to turn to the panel now for our very first question. And of these expenses, and I'm going to start with you, Alayna, which one do you think lenders would be most comfortable tackling first to reduce costs to positively impact their bottom line?
And we also have Roy here. Nice to see you, Roy.
Yay!
Excellent.
Hey, it only took me 20 minutes to figure out how to get in.
Good thing we didn't practice this yesterday at all.
Yeah.
I like to say I'm a salesperson, so maybe I'm not good with tech, right? That's the joke. No, I think the first thing we're seeing a lot of people tackle is trying to reduce their personnel cost, and we're seeing a lot of layoffs across both tech vendors and lenders that, when you get rid of your back of house, you're really eliminating a lot of things like your product lines and all of that. So I think we need to look at other things. That's all.
All right. Any thoughts on that to piggyback off of Brett?
Yeah, right now, obviously, everyone knows the mortgage market is, in decline, and we're having some struggles. Lenders have cut, really drastically over the last few years, and so I think these numbers may change over the next report, and we may see a realignment of the percentage of sales cost against technology. But kind of going back to that last slide, and then certainly calling out here, we do see that only technology is 6.7% of the total cost. Now, I'd be willing to bet that ourselves, even though we had some technology problems today, every single person on this call probably has their iPhone or their Android phone, if they're an Android user, within 6 inches of them right now. And so in an environment where technology surrounds our entire life, it is something that I think the industry needs to look at really seriously about where their investments are, increasing their tech spend in the right way. Not every single technology that's out there is going to drive down our costs. Some of them may just be an increase of cost, but I think it's really beneficial for a lender to evaluate their tech spend, make sure they have the right partners that they're working with, as well as how is it actually saving them money in relation to that the overall employment personnel costs.
Mm-hmm. Yeah, I have a fun calculation I always like to do with tech, which is how much time does it take to do a task? And then you multiply that by your loan officer salary and how much it costs them per minute to do a task. And I think that's something we really need to look at in regards to technology here when we're looking at percentages of expenses.
Absolutely. Yeah, lenders, I don't know if lenders are really diving deep into their cost of services, their technology, or even other areas of the business in relation to per role at the organization. You may actually find that some of the roles in the organization are driving a lot of efficiencies, and others may just be a cost. It is really good to break that down per employee or per role to see where you can find some efficiency gains. Is there value in actually adding some technology onto your stack to solve a particular problem? If you're not looking at the data and really analyzing that, you may be missing really great opportunities. Roy, you're at a lender. What are kind of your thoughts of some of the things you've seen this year?
Yeah, so I was just going to jump in on that comment you made, Brett. I agree with you that the benefit is there, but I also do notice that there are a lot of lenders not taking the action to actually figure out what these numbers look like, what these numbers are for them individually. What's occurring more often, and I've probably had meetings maybe once a week for the last 5 or 6 weeks in a row with lenders that are much bigger than my organization, some that are of similar size, some that are doing, 5 times my volume, all with the same challenge, right? Their cost to produce is way higher than what they can sustain. And it's because they're not taking the time to do this. What's in this chart that you provided is exactly what needs to be done for every organization so that they can really take a look at where their spending is and how to reel that in this market. There's nothing better than being able to make sure that you understand what the cost to originate per loan is and how that can be either redistributed or moved around as needed. And so I don't think there's a lot of people that are doing it regularly. And I think it's an exercise that is something that everyone does need to be doing. We take the time out every month to then reevaluate at the beginning of the month when we go over numbers to sit down and say, hey, this is how much it cost us to originate loan last month. What's changed? Has anything changed? Have we looked at anything differently in the next 30-day cycle? And it's because of the market we're in. Listen, if this was 2 years ago, maybe I'd be looking once a quarter or once every 6 months. But right now, we look at it on a regular basis to make sure that we're optimizing what we're taking in per loan.
Yeah, no doubt. I mean, I don't know about you, Roy, or the other panelists, and certainly our audience, but I've been through 3 or 4 downturns in the space. And so, we as an industry have come way too comfortable with the term that it's cyclical and it's a roller coaster. There's ups and downs in the market. And, we're going to hire, we're going to fire, and we're going to continue to scale and adjust our workforce depending on the market needs. I don't think that's very sustainable for our space. In fact, there's a statistic, I don't have the exact data, but it's been floated around that 1/3 of all mortgage individuals have left the space and are never coming back. We've got great talent in our mortgage space, and it takes a lot of time and money to train them and they get them up to speed. For us then to immediately lay off those individuals during a downturn is really disruptive to the organization and to the industry as a whole. And so I think we as technology providers are seeking to find a solution to stabilize that. Every one of our lenders we talk to right now say, look, we've cut as many people as we possibly can. They don't really anticipate any more cuts, thankfully. We don't want to see any more downturns or layoffs coming. But now the question is, what do we do if the market does rebound? If the market rebounds in the next 6 months and we have less staff, how are we going to be able to accommodate that? Are we just going to hire a ton of people and go scramble? Are those people even going to be available and willing to come back to the market? Those are going to be some real challenges we're going to be faced with. So, I don't know about the other panelists and how you seem like we could maybe stabilize that using technology or other methods, but I'd be really interested to see your perspective.
Yeah, I think one of my biggest concerns with that is, we are going to come back from this, right? I think this is at some point we will be at a higher volume than we are right now. It's not a question. So for me, it's about we have to look at our technology and think about also our implementation time and our implementation costs, right? You can't turn a technology on overnight. And I think that's something we see a lot on our side is we'll see a lender say, I want to be live next week. We're a pretty simple technology. We're a 60 to 90-day implementation, right? That is not a short period of time when you're talking. That's 3 months of disclosures that you don't have assistance on. So I think that's something that we really need to get lenders to understand is that you can't respond to these things. You can't be reactionary. You have to be proactive and protect your business now.
Which is perfect kind of lead in. Last week, we were at Digital Mortgage and noticed that a lot of lenders were sending their technical teams out there to help improve and research their tech stack efficiencies. And it seems that, buying of the technology may not necessarily be the real problem. It seems to be perhaps the lack of corporate adoption that appears to be the biggest barrier. So improving adoption rates now, for true operational efficiencies to minimize layoffs for the next rate swing, I think if it's done right, lenders won't need to throw bodies at the volume to keep up, thus more profitability. So as we move into the next question, I think for a conversation topic, what areas, what specific areas of technology enhancements for adoption would you recommend a lender focus on to make the biggest impact? What advice could you give surrounding the implementation for adoption?
I'll jump in and take that just first. Adoption is absolutely a conversation that needs to be had. As lenders have done layoffs in the past, the workforce in general is on a little bit on edge. And so as you choose to implement technology that conceivably could replace personnel, it's critical for the executive team to be upfront and honest with their intentions for the technology, to talk about what career plans look like for people that might be displaced with technology. We don't think there's any technology out there that can just at the click of a button completely eliminate our workforce. And so oftentimes it's going to be reducing manual tasks, streamlining efficiencies, adding some new adoption. One of our products, AI Underwriter, shameless plug there, does help and streamline the workflow for underwriters. But that doesn't mean we're going to lay off all the underwriters. And so if the executive team is not meeting with the underwriting staff and the support staff for underwriting and talking about their plans for that adoption of technology, you may find resistance with the organization to implement that. And so I think it's critical for the lender really to set the stage to increase adoption. Roy, you obviously are, front lines for that. What are kind of some of the things you do as you implement new technology?
So this is probably the portion of this webinar where disagreement will start to happen. I have a very, very specific way that I think about, how we build companies in the mortgage space, the ones that exist already. And yeah, adoption is key, right? Adoption is a huge part of why we can't get out of this cycle. We don't implement technologies um, in a way that is sustainably put into our people's hands where they feel comfortable using it, adapting to it and making it part of their daily routine so that things can get easier. Maybe there is a large learning curve in the beginning, but that's the pain that we do have to go through in order to get to the space where we are producing a product that is a far less costly product to produce than it is today. And you know, going all the way back to the last question and some of the comments made. Yeah, we have layoffs. We have to then come through this cycle. Then we have to hire all these people. Well, for new companies, and there are plenty of new companies that come into the fold when times are down, they can build in a form where they don't have to worry about that, right? They take that technology in right from day one. They build their entire operation around the use of those technology products or services. And then their people don't know an alternate way. There is no habit created from previous experience or whatever it may be. Now, yeah, that might limit you to a pool of, people that may not have the same level of experience that you're looking for. But this in turn gives you opportunity to train the right people. You are probably creating jobs that you might not have created before, like trainers, educators within your company that can help get you to that next space and to that more streamlined process of creating a loan. So, adoption, yeah, is a huge piece of it, but building the company properly right from the beginning, I think, is the key to making any of this work. Now, yes, the argument will always be there. What about all the companies that exist that can't just go away? You're absolutely right. It's a much more painstaking process to get a company that's already, functioning the way it is to function a completely different way. And plenty of people, whether they're on this call right now or they've worked wherever they've worked, have gone through that turmoil where they want to implement something that they know is going to make their life really easy. But then they've got pushback from every level of employee that's touching that piece of technology. Am I going to lose my job if we put this technology in place? Well, I'm going to nitpick on things that maybe I wouldn't have if I didn't have that fear of losing my job. Did we deliver the message that you weren't going to lose your job properly so that we don't get that pushback? I mean, and I could go on forever about that, but the reality is, you can build it right the first time. You can make the adjustments if it's already built, but you have to build it. Like Field of Dreams, right? You have to build it, they will come.
Yeah, and I think to Roy's point, one of the biggest things that we see in adopting tech is that clarity piece, right? Is you have to be very transparent with your employees of why you're adopting this technology, why you're putting it in place if you're an established business. Is it going to affect jobs? And if it is, be transparent about that. I think and say this is our plan to keep people employed. Is it training and moving people to different departments? Is it just a fact that there's going to be layoffs, right? I think we try and hide these things behind a shroud of glass, or a shroud of, I don't know, pick something, a curtain. There we go. But it's so important, I think, for us to have transparency with our employees, because it was one of the biggest things that we learned as a team throughout this layoff cycle. We were really, we're a small team. We were really lucky. We didn't have to go through any layoffs. But it was early on a conversation that we had with our employees is this could be a risk to us, is we could experience this. And I think it made a lot of our employees more comfortable coming to us and talking to us. And I think the same with tech, right? Is they know it's coming. They know it could affect their jobs. So whatever you're not saying is saying something to them.
Yeah. I actually really like that you brought up, Roy, the hiring new jobs and finding new opportunities for people. Right now we've got a workforce, and I kind of commented earlier that 30% of the mortgage industry just walked out the door. That's a lot of intelligence and experience from our industry that left and may never return. And so, where would you come to find a new workforce? Seeking out colleges and universities. You've got Gen Z coming up. You've got great fire and passion to use things. If you come into an organization and you hire somebody fresh out of college and you sit them down and say, here's a checklist, and I need you to go on this screen and compare this data to this data, and that's your entire job, you're going to lose that audience within seconds. They don't understand that. They have no interest in doing those types of jobs. And so you're catering to a very manual workforce that may or may not be somebody that can propel you to the next level. I think by embracing technology in a way, you are creating new opportunities, and you're also standardizing your workflow so that when you do train people in that area, they can understand the purpose of what you're trying to accomplish. It makes recruiting so much better. And whether that's a loan officer, an underwriter, processor, closer, otherwise, you've got a standard process, and that really can only be done through the backbone of technology and workflow optimization.
So here comes the next comment, and this one's either going to put me on the I hate that guy list, or he's right and I just don't want to say it either. You're absolutely right, Brett. We've got a lot of younger people coming in, for those that are recruiting younger people, for people that are, second generation, for people that are coming out of college programs and saying, I am going to get in the mortgage industry, right? Slowly that's starting to occur. And you have a much more innovative group. They grew up with technology. And the reality is this, and believe me, I'm a Gen Xer, and I'm not a millennial. I'm not a Gen Z. And I'm going to say this about my own generation and about myself. If I couldn't get myself there to say, hey, I want to continuously learn this new technology and do these things and adapt to what's available, then maybe it's time for me to find something else to do. And that is something that, from a leadership perspective at any company, you have to be able to say, hey, if my workforce is not willing to adapt, even though I'm providing retraining, redeployment, and I have to make that hard decision to say it's time to part ways. And sometimes as an employee, you have to make the hard decision to say, this isn't the way I learned how to do this, and I don't want to do it the other way, and I need to go.
Definitely something to ponder for sure. Again, with the aging workforce. So let's we'll pivot a little bit here. And let's as we've kind of been hammering in, we know that the operational efficiencies behind the scenes is going to be better for the borrower. The tech for it, it's not sexy like the technology you see for the CRMs, your point of sales, and perception is reality. That those sexier platforms provide the perception of a better customer experience. but we've all heard borrowers complain during the loan process. For example, they're asked to provide their bank statement over and over and over again. So if better operational efficiency, is put in place when it comes to embracing technology, how will that ultimately lead to an improved borrower experience? Why is it going to be better for the borrower, and how does the lender benefit?
I mean, at the end of the day, right? Yes, I think I'm going to use a hospitality metaphor here, because I did that for 13 years, right? Um, there are a lot of great restaurants that look really nice on Instagram, right? And you get there and you realize their service is terrible, the food is bad, and you just have a bad experience. But you're like, it's so pretty, and I got this really great drink. It only took 30 minutes to get to me. And I think that's very similar to kind of what happens when you don't have a good operational back end to match your marketing on the front end, right? You're almost selling this experience to a borrower that doesn't hold true throughout the entire process. You're saying, we're tech forward, we're this, we're that with your front end, right? And then your back end says, I need your bank statement 15 times.
Yeah, I love that you brought the hospitality up. I think everybody can relate to a restaurant experience. I also, was a chef in my former life and worked in back of the house, in front of the house as a bartender. So I can relate to those kind of experiences. I kind of see the CRM and the point of sale systems that have been put in place, absolutely bringing in new loans. At top of the funnel marketing, getting out there. That's been the predominant investment that the mortgage industry has taken over the past few years. And I feel like new investments in that area are not really necessary. It's getting adoption from those and really fine tuning your process at this point. In the restaurant business, that would be akin to you walk in the space and you've got a hostess. They're shining, you're there. Now I've got that thing. What do you do with it? One of the worst experiences you can have at a restaurant is the hostess says, hey, we've got a 20-minute wait, right? And they seat you in 35 minutes. People get upset with that. They will walk out the door and they'll tell their friends about it. But if you seat them faster than you told them, you've set very clear expectations and you've exceeded that expectation. So, going back to the prior question and maybe where some technology in the operational workflow can help is anything that can present clarity and upfront information to your consumer immediately upon taking that application. You want to set that expectation upfront and you want to be as accurate as possible. If you're not giving them clear expectations, you're asking for bank statements 5 times down the road. That's almost the equivalent of the restaurant waiter coming back and going, you ordered the enchiladas. Was that what you ordered? When they're expecting the food to arrive. So it's critical that we start investing in those operational technologies, whether it's efficiencies and automation in, disclosures, underwriting, processing, ordering services. Any of those areas can really streamline that process for your consumer and make sure that they're getting exactly what they need and they're clear and upfront about it right when they take the application.
I've been going to conferences that have been focused on technology for the last 7 or 8 years. And I honestly do believe we've had plenty of very smart people come into the industry, create or show us the technology available to do the very things that we're speaking of. And it all comes back to that same word, the adoption piece. I've seen some of those companies go out of business because there just wasn't enough, you know, people in the industry to purchase. But at the same time, there are competitors. They're slowly making it, and it's the adoption that just stops it from becoming the thing that creates the excellent customer experience. People, I see LOs that don't learn their POSs uh, well enough so that they know how to shadow or they know how to walk somebody through. I see people who are on the disclosure end of the table who still want to manually put something in place or go off of a fee sheet when they could very easily click a button and have Lodestar automatically put their fees into the system for them, or you have processors and underwriters. 4 or 5 years ago, I was using a tax service for tax returns, and it was AI driven. It was one of those services that read everything for you, and and still the underwriter needed to double check, even though at the time those things were D1C or day one certainty certified. and Fannie would accept the purchase of those loans based off of the certificate produced by the machine learning technology or the AI technology or whatever technology was behind it, that was actually providing the result. And that again diminishes that customer experience because you've prolonged the time. Now you got a loan officer out there saying, hey, I know we have this technology, we can get an answer back to you in 2 days, 3 days, 4 days, and then the other side of the fence isn't doing exactly what they should be doing to keep those timelines. Now you've got an upset customer. And
Yeah.
you can use it all, but you have to use it all properly. And when you're using it properly, you will give yourself the opportunity to give your customers the best customer experience they could possibly have.
That's so correct. We were at a sales rally in Las Vegas and for digital mortgage, and had the most unique experience coming back to the airport in an Uber car. We rented an Uber, pulls up in a nice Tesla. We were really excited about it, and we started talking to the driver about the car, as probably everybody does. I'm sure they're sick of hearing that, but found out they were a realtor in the space, and so immediately we were starting to ask questions about the real estate market in Las Vegas, and they were talking a lot about how they're losing deals to cash offers on a regular basis. And the predominant reason they're losing deals is speed to close. And so as we were kind of talking about some ideas, if a lender is capable of closing a loan, 7, 8, 9 days, which is very possible with the technology available, by us or by several other companies, they can actually compete for cash offers. What was interesting in that conversation is they were even saying that the real estate agents might oftentimes select the cash offer for self-serving purposes a little bit. They will actually select that cash offer because they get their commission faster. The transaction is closed quicker. The borrower, the consumer buying the home, has a better experience because everything happened fast. This person acknowledged that they might even pass up an offer that's $30,000 or $40,000 more that might take 30 or 45 days. So how are you as lenders getting in front of those realtors with a new message? Not just we got great customer service. Everybody says that. Few people deliver on that. They do a really good job, but you need something new and fresh. And I think speed to close, accuracy of close, is one of those things that really moves the needle in our space today.
Yep. No, couldn't agree more on that. I mean, as it relates to, again, reviews, the experience, as Alayna, presented, restaurant experience, you're going to Yelp to do that. For review experience, you're leaving those reviews on your loan officer's website so that you can share those speed to lead experiences, and all the way down to experiences of the vendors you're selecting. We know we can find those on mortgage advisor tools. So I think at the end of the day, it's all about the end the end experience. And I think too, we have a comment here in the chat. I'm going to read this out here from Stephen Curley. Also need to focus on the accuracy of the loan file that is being delivered to investors. Consumer experience is important, but it's also also finished product that's being delivered to the market. So I think, at the end of the day, those operational efficiencies are really what's gonna drive everything. So
Stephen bringing that up makes a really valid point. Like, my background's capital markets, and so understanding that delivery to your secondary market is critical for our business. Margins are very condensed right now. The yield spreads that are available are barely paying the bills, if at all. And so lenders are seeking new and unique ways to increase their profit on the back. One of those is, again, going back to speed to close a loan with accurate information. You can save 1 to 2 basis points per day by closing sooner, whether it's saving money on your hedge costs to minimizing the amount of lock period you have. Those are really great strategies to increase your profitability. But you can't do that by just throwing something over the fence. You have to ensure the accuracy of that loan file is really dialed in, and you have a high quality product so that when you do deliver it to the secondary market, you're not getting penalized for missing information, or maybe you didn't get an income calculation that was accurate, and getting buyback issues, which will erode all of those profit margins you had in the first place. So, absolutely, Stephen, I think you've got it on point that accuracy and delivery to the investor is critical if you want to increase your overall profit margins.
Great. I think this leads into our last topic of discussion quite nicely. So let's talk about the larger lenders, right? Are they really beating anyone with actual tech costs or with actual tech, or is it just the marketing smoke and mirrors? So how can the small to mid-size compete with what appears to be true end-to-end automation? So what are your thoughts on what the big guys are doing, in terms of operations? Do you think that they can fast track the mortgage process, making it more affordable for borrowers? And what is needed to propel the small and mid-size IMBs to be as competitive as those top lenders? What should their tech stack and services look like?
So, if you don't mind, I'll talk about the big company piece really quickly, and then we can go into more. But, coming from a few large companies over the last 10, 15 years and looking at the capabilities that executives and IT leadership put into place because we've gone over things over and over. We know we've tested them. We know they work. Is one way where we think, hey, we've got what we need. The smoke and mirrors piece is not created because the technology isn't available. It's created because nobody wants to use that technology properly. And when you don't use it properly, or if your whole team isn't using it properly, you run into the challenge where everyone thinks it's just smoke and mirrors. And give you a right example. Um, I've met plenty of loan officers working at some of the largest companies in America today over the last 7 or 8 months who don't know that their technology has, I'm sorry, that their company has certain technology or certain capabilities. That blows me away. If you work somewhere and you didn't know that your company had the functionality or the capability to provide an experience to a customer that was faster, better, more to the point, and you're still doing it whatever way you decided that was the way you like doing it or the way you learned it, you're going to cause that smoke and mirror situation for a lot of people. And I think that's something that a lot of us we don't see when we're looking at it from the perspective of, hey, we know this company does X. Yeah, that company does do X, but their people aren't executing X.
I think there's a wonderful quote that's called it basically says, I have no idea who says it, but excellence is not what you do once, it's what you do every day. Right. And I think that can be held very true for a lot of these large lenders. I've talked to shops that have different tech stacks for each branch, for each acquisition, for this and that. And I think if you're going to be a large lender in the space, you almost have to say, this is the way we do it and not bend to the will of your branches and to your organization, right? Because I think what happens in those situations, I've talked to a lender that has 5 POSs. That's a lot. And just isn't honestly necessary. And I think that's one of the biggest things is how you can't drive adoption if you're not mandating it, unfortunately, in a lot of places. Yes, you can go for buy-in and all of that, and you're going to have your late adopters. But at the end of the day, I think one of the things that I've learned in this industry and in my career is change is uncomfortable and painful, and sometimes you just have to do it.
Yeah, there's a great comment again. Christopher Call's got in our chat. They're talking about change management is really the way that you adopt any change, whether that's a technological change or a training issue or just a new philosophy or a new process that someone implements. You have to have change management. All the lenders, excuse me, that we work with, the ones that are successful have really dove into and embraced change management. That is not the change management of like, hey, this release, we're going to do this. It's the practice of change, like ProSci. It is why we're changing something, the culture around change, the training, the excitement. You almost have to market to your internal people about a change. They are your stakeholders just as much as your customers are. And if you're not considering their needs and how they're interpreting whatever change you're doing, you're missing half the equation. And so you really do have to focus on that change management if you're going to be successful. Also kind of pivoting a little bit, another comment that I see that's great on there is, technology isn't always the fix. Absolutely true.
Yeah.
Maybe technology can solve the problems. I think, I as a technology vendor really believe technology has a lot of answers, but should you? Right now, if we can speed up the amount of closing time to 7 days, 8 days, that's really fast for a customer. We had a customer actually reach out to us, a story from a loan officer that said they came and had a clear to close in 8 days. And the borrower was really overwhelmed. They were stressed out about that. They were like, that's too fast. We're not prepared to close. And they said, well, you don't have to close. You can close in the next 2 weeks, whenever you want, but we're ready. It put them back on their heels. And so I think in that environment, it's an opportunity for originators to be that human touch. Blake, you said ICE, bet a huge amount of money on a brand new platform and is really going in with technology. Well, years ago, they said it was high touch with high technology. And so lenders need to be a consultant to reach out to their consumer and guide them through that process, especially if it's only going to take 8 or 9 days. What a great opportunity for them to reach out and have that personal touch while this technology behind the scenes is empowering them to actually execute effectively there. So I think it's a really exciting time.
And one thing I just want to say is, I think it's Chris had a great point here with the one size doesn't fit all. I think you should be asking your vendors, why shouldn't I choose you? In what situations would you not recommend your technology, right? Because you don't want a vendor who is trying to be everything to everybody. You want a vendor who wants to be there and work with you for the right reasons. I will tell lenders all day if they're not the right fit for me. And I think that's important to recognize, is who's there for the partnership and who's there for the sale.
I couldn't agree, with you more on that statement. When, searching for new vendors, CRM providers, marketing, technology, of course, we want to be able to minimize the amount of vendors we're bringing on board, but please tell me if you can't do X, Y, Z. Don't tell me you can build it. I don't want you to do that. I want to be able to select the best of what you do, and trying to be everything to everyone. Again, it makes it quite challenging, and that's where you lose, the engagement and the adoption rates. And the frustration, because many times you have one time to do an implementation right. And if you don't, your team will let you know.
Blake, you're absolutely right about, doing, what they're capable of doing, or really focusing on their best skills. Something that we see a lot when we do implementations is people will try to solve every single possible scenario. They will spend the vast majority of the implementation on the 5% of issues. And they're frustrated sometimes when your answer is, put that aside right now, make a manual process. It's totally fine to come up with a checklist and an employee to supervise that 5%. If you're seeking perfection from any technology vendor and they're telling you, yes, we can do it all, you've got a problem there. Get that 80% done, get adoption up, get some value out of that, actually see hopefully your costs come down, and get a lot of momentum going forward, and then come back around to that 20%. There's a lot of value in the 20%, but don't focus exclusively on that when you implement a new technology or process or anything else for that matter.
I think one other thing to remember is when you're looking at technologies, you've got to look at the ones that seem like or have the ability to show you that they're able to move with the times, they're able to adapt to the things changing around them. They have the capability to allow you to connect to other things, and the real capability to come back to that 20% that you want to focus on after the initial implementation of whatever the technology is.
Absolutely. Well, I know we have about 5 minutes left. I'm going to stop and pause there. Any additional final words that you'd like to share with our amazing group of attendees today? All right. Well, super.
Yes, I would probably just wrap it up and say right now really is the time to go on offense. We've been playing defense for an entire year now. I think we've done everything we possibly can do to save money and to streamline our operation. Now go on offense. rates will return. And if they don't return, the market will become acclimated to this, and you're going to want to be that leader. Those that are willing to go on the offense and change things and implement new solutions are going to be the one that start to capture that market share. So, it's risky, of course, but get out there and get on offense.
Here's maybe a great question. I don't know if you saw this one pop up, Roy, in the chat.
I did.
One of the biggest you saw that one. So one of the biggest challenges I've seen is the hiring of originators that come from the bigger shops. So helping them transition smoothly into a smaller shop, getting them up to speed where they're very used to the automation of processes. How do we address that without disrupting the momentum of getting new leads?
So I'll take that. I am that example. I am a much smaller organization. I do recruit from the big banks or the large mortgage companies, not actively, but we do recruit where there is a need, and we get a lot of people from those types of organizations that reach out to us. So how do we transition them without the challenge of what they're already used to? Well, first and foremost, number one is communication. When they come in to talk to us, we let them know what we look like from a technology standpoint, what we look like from a timeline standpoint for things that we might be looking to implement or develop over time. We show them our systems, exactly how they work, so that before they make that decision, they're already looking at it saying, can I be comfortable with this? Am I comfortable with this? More than likely, they're coming from large shops. So if you're really large, you might have a proprietary system. If you're big enough, you probably have the most well-known system in the mortgage industry landscape. And if you're using a proprietary system or the big boys, then you are running into, this is how it works. This is how everything works. This is all I know. And you've got to be able to show them the lending pads of the world, the arrives of the world, the other options that are out there in the world, and let them actually utilize it. Because it's not until they get used to pushing the buttons that they see how much better those things are than where they came from.
Yeah, I think another way to address that is, again, right, just to hit that communication point really hard. People are pretty fluid. They came to you. They want to be part of your organization, but what they do need is insights into what direction you're going. They may not need everything solved today, but they want to know you have some vision for the future. So I think a great way to do that is a senior leadership and executive team putting together a roadmap for their technology. And vendors like Lodestar, Lender Toolkit, and many others will collaborate with you on building that roadmap out. And if you stay focused on that roadmap and you deliver and execute on that roadmap, then those that are coming in are going to be more comfortable with waiting a little bit to get it versus just, we're going to look at some things. So, if you put a clear, concise roadmap out there and you have a plan and a vision, it really goes a long way with all your individuals. So hopefully you can spend some time doing that.
Yep. And being that, I've helped onboard hundreds of loan officers over my career. I strongly encourage you guys to have a very strong onboarding process. Partner up with your learning and development team. Make sure that they don't become overwhelmed, that they know the steps in bite-sized pieces of what they need to do. Help them understand how the very first thing they're going to want to do is, how do I input a loan and how do I make it easy so that they are comfortable getting out there and focusing on lead generation. So I think sales enablement, again, stepping away from the technology side of it, sales enablement, automate how that process flow should look, but really have a strong onboarding process. Leverage your learning and development team if you have that, and make a program of it. They will feel comfortable and confident and know where they need to go for loan scenario questions, so on and so forth. So I think that's a really important thing as you're bringing on board and setting those expectations up front from those loan officers coming from very structured environments. So with that, let's wrap it up here. So thank you so much again for joining today's session. I hope that we are inspiring you to think and act differently, and helping stop the dysfunctional cycle of mortgage lending. And Also, I want to make sure that if you are heading to the MBA annual, our friends at Lodestar and Lender Toolkit, they're going to be hosting a kickoff party. Apparently, there's going to be ping pong there. So I'm going to say, need I say more? So go RSVP today. There's the link right there on the screen, and have an amazing one.
Thanks, everyone.
Thank you.
Thank you, guys.
Thanks,
Bye-bye.
everybody.